morning, everyone. Welcome to follow Cramo PLC's third quarter 2014 interim report presentations. As usually, we are here, I'm CEO Vesa Koivula, and I have here with me Martti Ala-Härkönen, our CFO. So we will go through some highlights of our fresh report from this morning. So content is following our usual content, some highlights and group performance figures, and at the end of the presentation I would like to highlight a little bit how we are implementing now quite recently updated strategy going forward. So let's get started from some highlights. First of all, the third quarter was a challenging time in our business, and especially their first half of the quarter was even difficult in some markets. That was the time when our sales was not really developing as it was expected, because normally the third quarter months are good months for developing the sales. Anyway, towards the end of the quarter, our sales started to improve, and finally we met more or less our expectations during the third quarter. This was clearly seen also in the utilization rates of our fleet. So utilization was below last year levels more or less until September, but then we have reached utilization improvements, and now the utilizations are even somewhat above last year's levels. And of course this is now good standpoint to go forward this quarter, and why not also towards the next year. Our euro-based sales was slightly lower than last year, both in the third quarter and for the first 9 months. Counting in sales anyway in local currencies, it was plus 1.9% in third quarter and 2.1% plus for 9 months, counting excluding the restructuring in Russia. In this quarter, we achieved a positive result in all business segments. That's of course the good point in this quarter. Despite the weak market situation, the result was very good level, on a good level, and continued to improve in Finland. A good result was also achieved in Sweden, even though the market started to improve later than we expected earlier. Actually, only towards the end of the quarter. There in Sweden, we also reduced our fixed costs as was planned earlier. In Norway, operational efficiency was improved according to the plans, and the results are expected to show towards the end of the year and fully finally in next year. In Denmark, the market situation developed well, and the result for the third quarter improved comparing year on year. In Central Europe, the quarterly result did not meet our expectations. Early in the year, costs related to the extensive transition program weakened the result, and now in the third quarter the result was weakened especially by sales being lower than was planned and expected. The utilization rates of the new product groups in Germany especially are increasing steadily, but construction machinery utilization rates in the third quarter were lower than in the previous year, and that is still the core business for us in Germany. So during the period, also the cost level was lowered and performance improvement actions were increased Now, increasing fleet utilization rates is still a key objective in our performance improvement going forward in the Central Europe and Germany markets. In Eastern Europe, profitability improved in the third quarter with the exception of joint venture Fortrend operating in Russia and Ukraine. However, Fortrend succeeded in adjusting its cost base to the weakened market situation, and actually also Fortrend's result was almost at the previous year's level. Also, the cash flow for Fortrend was on a good and even strong level in the quarter. So overall, we can be reasonably satisfied that after challenging months now in Q3, the profitability was only slightly below last year's level. Taking some of the figures before Martti goes more into detail, this means that in the quarter our sales was 171 million, our EBITDA profitability 30.5, giving a margin of 17.8%, comparing the last year's 18.6%. And this gives EPS profit 45 cents. So then, if we see some of the updated lead indicators for financial or economic situation and construction situation in different markets, starting again of lead indicator of economic sentiment. These are fresh, updated estimates. This is from EU. So this shows that the black curve, which is the overall sentiment in Europe, has been declining during third quarter. So actually we are now on the pretty much the same level than at the end of last year. And the best sentiment is again in Sweden and Germany. And then Finland, as we well know, is having at the moment the weakest sentiment. If we see the same for construction, this is again from EU. So the black curve here shows that overall the construction confidence and sentiment has been actually improving during the quarter. And the highest sentiment is in Sweden, which is good for us, and Germany also, even though somewhat coming down, but historically still confidence looks good also in Germany. Poland, there the market expectation is improving, and again then on the lower side and weaker side, Finland is clearly below their average sentiment in EU in construction. Then if we see more closely what is then the GDP expectation, I think when reviewing now next year, especially what comes to these estimates, is that this has been all the time positive also for this year, but our experience has been that in most of the cases the outlook and their actual economy has been somewhat improving, but it has been weaker improvement and somewhat delayed from earlier estimates. So of course, at least what comes to our budgeting, we keep this in mind. But seeing now as such a positive outlook for next year and for this year, because for this year almost the only negative GDP expectation is for Finland. The other countries are having pretty high. For Sweden, Poland especially, the expectation is good plus GDP growth for this year. So how this reflects then our views for next year? We have a cautious view, But of course, when all the estimates are positive, so when now starting and going on with the budgeting, this means that we are expecting that the growth possibilities are good for next year. So that's our standpoint for next year. So it should be a growth year. Then if we go closer to rental estimates, this is again updated lately by European equipment rental industry. For this year, they forecast that Finland is, or Finnish rental market is declining, and the other markets are quite well or slightly growing. And then for next coming years, the expectation is that all the markets have been pretty, or should have a pretty steady growth. Also, this, of course, we have to now cautiously view by quarter and see how finally the markets are developing. But this supports also the view that next year all the markets should be growing. Okay, here I want to highlight, first of all, on the right side, you see the growth drivers for our industry, but especially summarizing our situation in view of total market in Europe. Total market size is estimated to be today around 20, or this is actually 2013 figure, but roughly also today maybe somewhat higher, but 23 billion euros. So where are we there then? First of all, we are in one of the most advanced market. We are strong number one in Sweden, where the construction penetration for rental is also the highest. And actually, also the market size is something like fourth largest in Europe. Then on the right side, we see that Germany is the third largest rental market in Europe. And now we have such a good foothold on the market. But I will talk later and continue to talk about how we are going to improve there. So strategically, we have interesting situation being one of the most advanced rental markets, and then one of the largest rental markets. All right, this was the short highlights and summaries. So now I let Martti to continue with the financials.
Thank you, Vesa. The core message of our Q3 2014 report is performance improvement actions. Performance improvement actions proceeding. What we are saying with that, and what's the sense of that, is that the reduction of fixed costs and the other performance improvement actions which we initiated in the second quarter of this year are all proceeding according to plan and are further being now enhanced in Central Europe. And this again, together with the implementation of our focused must-win battles, which are also ongoing, provides us with a good platform for profit development going forward. So let us start looking more closely at the results of the third quarter. And starting with sales, in the third quarter, our sales reached 171.1 million euros. This was 2.5 million euros or 1.4 percentage points less than a year earlier. So again, and still, the weakening of the Swedish krona and the Norwegian krona adversely impacted our euro-based sales. But what is more important here is that in local currencies, sales increased in the third quarter by 1.9%. Still looking back into the third quarter, sales-wise, it was a bit twofold, like Vesa was describing. In the early part of the third quarter, our sales developed more weakly than we had anticipated. But what is important, that in the second part, the sales were meeting all our expectations. Still, if I look as a whole of the third quarter, the sales growth in local currencies, 1.9%, was slightly below our earlier expectations. But important again, that in the second part, everything went according to expectations. And accumulated for the first 9 months of the third quarter, first 9 months of this year, our sales reached 471.2 million euros. That is 11 million euros, or 2.3 percentage points less than a year ago. But again, in local currencies and excluding the restructuring in Russia, our sales grew by 2.1% in the first 9 months of the year. In local currencies, segment-wise, our sales increased in the third quarter in Finland, Sweden, and Denmark, while decreased in other business segments. Then turning to our EBITDA, in the third quarter, our EBITDA amounted to 30.5 million euros versus 32.3 a year earlier, and the EBITDA margin was 17.8 versus 18.6 a year earlier. So not a big decline, a slight decline year on year. And overall, there was a positive result achieved in all the business segments, but still profitability, like I said, was slightly below last year. Overall, however, we are, I would say, reasonably satisfied with our result and performance in the third quarter, with the exception of our performance in the third quarter in Central Europe, and partly also in Sweden. In Central Europe, the transition program, like Vesa was already saying, has not fully yet met our expectations, but we are currently very determinedly enhancing our performance improvement actions in that market. The adoption of the performance management model at all depots is proceeding, and fixed costs are reduced more intensively than before. And we strongly believe that we can see positive effects of our efforts latest in 2015 in that market. As for Sweden, the upward turn in the Swedish market occurred somewhat later than we had anticipated. However, regarding Sweden, what is very positive is that, which is also our largest market, is that the results started to, or the results in the latter part of Q3 indicated a favorable development going into the fourth quarter. And as we all know, the markets as such, the construction market, they are growing currently in Sweden, which is a good starting point going forward. Accumulated for the first 9 months, our EBITDA was 47.3 million euros, and the margin was 10% versus 11.4% a year earlier. This picture describes the EBITDA between the third quarter of last year and the third quarter of this year by business segment. And first of all, what we can see here, the segment-wise, there are also positive developments clearly in the third quarter. Starting with Finland, our profitability continued to improve in a weak and difficult market. Our profitability also improved in Denmark and also in Eastern Europe, excluding Fortrend. Regarding Fortrend, which is our joint venture operating in Russia and Ukraine, there also we very well succeed in adjusting our cost base and profitability, and the result was almost at the previous year's level. If one will look more closely on our results by segment, still the result in Sweden was also good, although like I said, the market turn occurred later than we had anticipated. We succeeded in reducing our fixed cost base, but when the sales were ramping up, the direct costs were somewhat high, which is quite typical when growth kind of starts. In Norway, the operational efficiency was improved according to the performance improvement plan, which we are taking forward. And we expect the results to show more in the fourth quarter and fully in 2015. And then for Central Europe, like I said, results did not meet expectations in the third quarter. The shortfall, which is attributable to sales were clearly lower than we had anticipated. In the new machinery, our utilization rates are going steadily up, but in this quarter, the utilization rates for construction machinery, which is you could say the core old fleet structure, their utilization rates were somewhat lower than last year. Still, I think the main issue for this graph is that we have performance improvement actions in place for all the segments with a negative gap. And also, we have, I think, succeeded quite well in reducing our fixed cost base now in the third quarter, which has been the result of the performance improvement actions. And these are issues that Vesa will later review in more detail in the third section of our report. Then continuing to earnings per share in the third quarter, both the diluted and the undiluted earnings per share were 45 cents versus 48 cents a year earlier. That's a reduction of about 6% year on year. And it's good to mention here also a few lines in our profit and loss below EBITDA where we have positive development. Regarding our net finance costs for the first 9 months, they amounted to 9.9 million euros, which is 1.2 million less than a year ago. And actually the improvement was slightly even bigger in the third quarter. Our net finance costs were 3.1 million euros versus 3.7 a year earlier. So there's a reduction of 0.6 million euros in the third quarter. And also for our effective tax rate, now for the first 9 months, it is 20.7% versus 21.9% a year earlier. And also our best estimate for the full of this year is this 20.7% at this stage. Then looking at our return on equity on a rolling 12 months basis, it was 8.2% at the end of or in the third quarter versus 8% in the third quarter of last year. And here also I want to state that all efforts continue to reach the financial target level, which is over 12% ROE over the cycle. And we are currently seeking improvement, especially on 2 fronts. First of all, the performance improvement actions, which we are taking forward in Scandinavia and in Central Europe. And then second is the implementation of our focus strategy and must-win battles, which are all addressing key areas in our profit and loss and also balance sheet, which we expect to drive our value going forward. Then looking at our quarterly CapEx, capital expenditure, in the third quarter, the gross capital expenditure was 45.1 million euros. There is growth of 14 million euros year on year, or 45%. And by business segment, gross CapEx grew year on year, especially in Central Europe. In Central Europe now, our offering has been developed according to the Cramo rental concept. But from now on, new growth investments in Central Europe will not be made before the fleet utilization rates reach our target levels in that market. As for product areas, we have continued growth investments, particularly in modular space, and that business is and continues to be doing very well. And accumulated for the first 9 months, our gross capital expenditure was 125.5 million. There is growth of about 26.9% year on year. And if I now look into the fourth quarter of this year, our capex in the Q4 will be clearly lower than especially in the last 2 quarters of this year. By far the majority of this year's investments have already been completed, and from now on the focus is on further trimming our utilization rates in all our key markets. Then looking at our quarterly cash flow in the third quarter of 2014, our cash flow from operations was 33.2 million euros. There's a reduction of 17.7 million euros year on year. This comes from the fact that if you're looking at operating cash flow, the change in net working capital, looking periodically of Q3 of this year and Q3 of last year, there is a difference of 17 million euros. However, this is a periodic issue and one shouldn't be worried about that. We expect net working capital to be released now again in the fourth quarter. And also, if one would look into the, for instance, the quality structure of our receivables, there is actually an improvement year on year. So the net working capital I expect to be released and rebounds back as we go forward. Cash flow after investments was minus 5.4 million in the third quarter. This was affected by the lower operating cash flow and also by the fact that our organic fleet investments were higher than last year. Like I just stated, the gross capex was 14 million higher in the third quarter than last year. And as I have said earlier regarding this year we expect our cash flow to be strong, particularly in the fourth quarter. And this still holds as I look into cash flow for this year. Also in this graph, we can see that in Q1, our operating cash flow was negatively affected by the residual tax payment of 9.7 million euros in Finland. We consider that to be unfounded and are actually currently waiting for the issue to be solved in our favor. Finally, looking at our capital structure, at the end of the third quarter, the net interest-bearing debt level was 450 million euros, somewhat higher than a year ago, and the gearing at 85.6%. So the gearing is meeting well the financial target level, which is under 100%. And following an expected strong cash flow in the fourth quarter, and as we can see also in this graph, in all the years, the gearing has come down in the fourth quarter. This is also our expectation for this year. And finally, before I hold back to Vesa, I want to summarize that all our efforts, projects and actions, they continue to be focused on issues driving value going forward and how we can move towards delivering our financial targets. And I think personally that the progress we made in Q3 gives a good platform for our profit development going forward. And Vesa will continue from here.
All right, so let's continue by looking a little bit more closely to our performance per segment. Starting from a very positive segment, in Finland, in a very weak market situation, we have been able to continue good performance. So this means in figures then if we see quarterly performance, sales was growing by 2.8%, and as a profit we made margin of 25.7%, which is higher than last year, even clearly higher. And in accumulated figures, this means that we have been growing slightly, 1.5%, and our profit has been above last year, well above last year now, with 19.5% margin comparing to 17.2% margin last year. So overall, very good performance has continued. As I said, underlying market is weak. Construction is not growing. Actually, it was lately published again a new updated outlook for construction, which was slightly more negative than the previous one. So for this year, construction is expected to decline by 2%. And actually for next year also the general outlook is slightly negative. Almost the only sector which is growing is for construction is the renovation sector. What is of course good for us is that we are a strong player in modular space, and modular space has been performing and continued to perform very well also in the third quarter. Of course, what are the reasons why we have been able to keep this good level of performance? Now we see the results of our long-term, many years work to implement our performance management in place. And actually Finland is the country which is most advanced of all our countries, including Sweden. So we have implemented, not all yet, but the best implementation of our management systematics, and that allows us much more closely to follow up our actions, what comes to sales activity, what comes to cost levels in our repair and maintenance, etc. And of course this is the aim to continue in all the countries. So we should be on the level that we have implemented in all countries. I will shortly come a little bit back to this issue as well. So those are the reasons why in a weak market we have been able to keep this performance on a good level. Sweden, finally we made also reasonably good result here, which means that in the quarter our sales was slightly decreasing, but in counting in local currencies it was quite clearly even growing. And quarterly EBITDA was slightly below last year, giving a margin of 22.4% instead of 23.8% last year. And in accumulated figures, we are now having 2.5% lower reported sales than last year, but again in local currencies a little bit higher than last year. And as a profit margin is now 16.9%, whereas last year we reached 17.8%. So we are now closing the gap in Sweden against last year. Then if we see what is happening on the market, I think we have already commented that we have realized that this strong expectation of the market improvement has not come full, and it has been starting to come now gradually. So some kind of delay there was, because we saw that our utilization started clearly to pick up actually in September. So market is now expected to continue to grow, and this is of course a good standpoint to go forward in Sweden. We are strong and we have a strong market as we have had already for some time in Stockholm, in southern parts of the country, whereas north and west has been somewhat weaker, but the late development has been also a little bit more positive in those areas as well. Of course, when the markets are now turning more to growth, we have to consider then the pricing as one component to increase. At least what I can say now is that there should be good possibilities to increase, at least in some selected segments, the prices. And this is anyway we are doing with our new pricing systems, which is called this right price, which we have thought about at least in our Capital Markets Day. So by this we expect to have even now stronger performance for Sweden in the coming times. Next one, Norway. We see first the figures again. In the quarter, our sales was declining 7.6%, a little bit less in counting in local currencies, and we made a profit only 1.4 million, giving 6.4% margin, clearly below last year margin. And same goes for our 9 months performance. Sales clearly below last year, and profit margin now 4.7 against 6.6 last year. Of course, we have reported earlier these are not good enough performance figures. Why it is so? The fact is that the market has been challenging in Norway throughout the year. Now what is seen is that there was a positive development in building permits for new commercial and office buildings during the third quarter. On the other hand, then new residential construction is expected clearly to decline, even 9%, whereas the renovation and civil engineering sectors are projected to be the areas where there will be growth. So overall, it seems that the total construction for this year is not basically growing in Norway, when the expectation is 0.4% plus only. And of course, this has put challenges on the rental business as well. Our present situation is so that those plans which we have reported earlier, meaning that we adjust our operations into this changed market situation, has been mostly done, and that gives us, of course, now then I would say good platform to continue towards next year, because the impact of this restructuring is somewhat of that is coming during the rest of the year, but mainly and fully the impact will be for next year. So main target is to have a good platform for the next year's improvement or performance improvement. And actually the market expectation is also somewhat more positive for next year in Norway. Then Denmark figures, we made some 4.6% growth in quarter in our sales, and we made a small plus in profit. It was higher than last year, that is good, but 4.6% margin, of course, is not good enough. And as we recall that first 6 months was weak market situation, and we made weak performance. So now we are still somewhat loss in our 9 months figures, having 1 million minus profit. One of our key targets also for third quarter was to make now black figures and positive. So that was a positive sign. What are then our next steps? Taking into consideration that market has been now starting to improve in Norway, in Denmark, what comes to construction, and we are expecting that the market improvement then follows also to rental industry. So we expect that of course we could continue now to produce positive figures, and for next year the aim is certainly then to make really much improvement in Denmark. The actions which we have so far taken is that especially we have taken actions in order to improve our direct costs, and that's very much taken in relation with maintenance and repair. And also we have renewed somewhat our fleet, which was becoming a little bit old after not having investments made in the market. Then we take Central Europe, which we have already commented a couple of times. But if we see now first the figures again for the quarter, our sales was down 4.4% from last year, and our EBITDA was only slightly positive, so 0.4 million, whereas last year we were clearly more positive with 2 million profits. And this following our 6 months development, this did not improve very much that, so we are now clearly on loss in Central Europe. Then if we continue to comment what is our phase in our transition program. First of all, I want to state that the transition program it's a 3-year plan, which is still ongoing. Unfortunately, the result now has been burdened not only by the cost of the program, but also during this summer, also weaker than expected construction equipment rental market, which is our core business there. So the utilizations for that part, or for that segment, were lower than normally. On the other hand, now we have had these extra costs during the whole year, so we have now all fundamental business I would say, business tools in place, which means that we have a new ERP system in use. We have renewed our processes there, and overall the management systematics are in place. So now the work continues, and we are convinced that now when we gradually can concentrate only in normal business and in ramping up the sales and utilizations, so then we are in a much better position to really get higher and improved profit. So that's in a way where we are now. And as I in the very beginning already mentioned, the key is to ramp up the sales and now increase the utilizations, not only in these new investments, but also in this old core business. By the way, we also now have changed totally the brand. So there is no Thyssen brand anymore. When traveling now, some days back, I didn't see anything about Thyssen anymore. So everything is branded now in Cramo, and of course now we do utilize this brand also in our marketing. Eastern Europe, in figures, quarterly performance, slight decrease in sales, EBITDA 4.3%, practically almost on the same level than last year. So margin is also very close to last year margin. And in 9 months, this means that we have had this decline in sales, which is very much coming from the fact that the incomparable figures there is this transfer of our operations to Fortrent last year. And in profit in 9 months, this means that we have now 11.1% margin. I already commented on Fortrent. So here we have also figures on sales. We made, or the company made 10.4, which is clearly below last year, above 20% lower. But the profit was still keeping almost on the same level than last year. This means that the local management has taken actions and adapted to the present situation. So I keep this as a positive sign that in a very difficult market in Russia at the moment, they have been able to perform at least in this level. What comes to other areas for our operations, we are having very good margins in Estonia and other Baltic countries. In Poland and Czech, we improved quite well our margins and profit towards the end of the quarter. And going forward, I would expect that especially Poland, as a bigger market, could have good possibilities to really perform much better than what we have seen, because the market is what we see from the outlook and estimates. The market is somewhat picking up now. Actually, small improvement on the market conditions is also seen in Czech. That's a small area for us, and we are making there reasonably good performance. Okay, that was comments for each segment. Then if we, in the last section, start for updating a little bit or wrapping up. We have now commented already from different angles what are we at the moment doing in order to improve our performance. It's very much related having cost reductions and good control there, but not only that. So in many areas, it's of course very essential to put more and more efforts on sales. So if we just wrap up with this slide, so we have here, these are the areas, Central Europe, Sweden, Denmark and Norway, where the most of the actual actions are ongoing. So once more for Central Europe, it means that the transition program will continue. And now the crucial thing is to ramp up more sales, and at the same time, which we have already started also, to take somewhat down our cost base. So to make a good balance there, and that's where we are. For Sweden, we are reporting that our direct cost control has been now in place, and the actions have been implemented. Now we have more focus in direct costs, which means that our definite aim is to improve our gross margin in Sweden. And there we have special programs ongoing locally, how to do that, and the follow-up. For Denmark, it's very much to go on with their full implementation of our dynamic pricing system. See also a little bit direct cost. Also there we have room for a good improvement in gross margin. And we have to look further how to support the as such now growing market with some targeted investments, not starting too much to put money in investments yet. And finally, in Norway, as already mentioned, the plans have mostly been implemented, and of course the aim is mainly to have then full effect for our next year performance. This means then practically in figures that if we see now quarterly development, so our indirect costs are now clearly below last year. So we have been able to implement now indirect cost savings there. But on the other hand, if we see then 9 months, it's not so strongly seen, because most of this impact came during the third quarter. And then capital cost, we have now invested in growth it's basically mostly in Sweden, Germany, somewhat in Sweden, and of course in modular space. And that's why our capital cost is somewhat higher. Depreciation is somewhat higher. But overall, fixed cost level in third quarter was decreasing. Then, if we go back to our materials, which we presented in our capital markets day not so long time ago, but I would like to take some highlights out of here as well. As we have disclosed, now we have still more focused strategy. We are implementing the strategy with must-win battles, as we have done already for several years. But now we have only 3. Deliver Cramo story, drive further the performance management, and then we have to win the Central European market. Especially I would like to just practically try to explain what does this mean, deliver, or what is Cramo story. So in practice now, when soon we will start launching this externally to our clients, this will become more tangible, visible. So first of all, it means that if the customer is not satisfied with our service, he can always contact our so-called ombudsman, and he can get a bonus by helping us to improve. And this is very practical. Secondly, we are always in time with our deliveries. If we are late, we will compensate. And then thirdly, we are always there. So if we cannot fix equipment which has a malfunction in 4 hours, again we will compensate. So these are becoming now very practical issues. The background why this is a good or big issue, a strategic issue for us, is that this means that we have now been training all our persons every single person in the company to understand and start to behave in accordance with this. And this is actually one of the biggest development projects we have ever had in the company. And also we are starting to follow up this. So this means that we have also software in our ERP system so that we can recognize that are we now fully then following our promises. So this is very new, I would say, in rental industry, and we look forward that this will really be an important part of our strategy now when going forward. Okay, that was explanation of what is the Cramo story. Then if we shortly see that why this and what will be the impact, we expect that this story will increase our sales, and on the other hand also decrease our direct costs when we just all the time trim our services and service levels. For Cramo performance management, as I already mentioned, Finland has been mostly already implementing this. So here, of course, we look for further sales increase and then indirect cost, direct, indirect cost, and also depreciation decrease. So where we are here, we have in almost all of our countries, we have implemented already this on the depot level. What we are now expanding is the same kind of system in our repair and maintenance processes, also in our sales processes, which means that then we are able to really closely follow up how active we are and how we are succeeding in our sales activities. And finally also this is then implemented into the purchasing activities as well. And then thirdly, win Central European market. But I think now I have and we have used already so much time on explaining this that it is just to summarize here that this is also a must-win battle for Cramo in coming years. So this is where we are with our implementation of the strategic activities. And here, just to summarize historically that where we are, after 6 to 7 years of having high growth, we had then this operational excellence time when we created and implemented mostly our harmonized processes. And now it's time to still deepen our use of all these harmonized processes, and we call this time then to implement the Cramo story time and continue to have main focus on profitable growth. Okay, before I have my last summary slide, modular space, I would like to highlight also something there. I commented only that in Finland, in Sweden, we are having very strong performance continuing. Here is some highlights of how we see that we will drive further organic growth and inorganic growth in modular space. First of all, we of course look for further continuing investing in business and growth in Nordic countries, which is really our strong home base. On the other hand, we look for new solutions on top of existing, how to also expand application-wise our modular space in Nordics. Then now we are in Germany with modules. Start has been good so far. So of course we drive forward CS Raum, steel-based container or modular business, but also we continue to implement the other type of products, which is basically the Nordic type of high-class modular buildings. And also we continue to develop our operations in Baltic countries within this. Inorganic, we look for further possibilities to make acquisitions. In Germany, one option could be also only for modules that we expand to all some other markets. So we see that we have now very strong foothold as a modular company, and that's why we look for also other markets and options there, how to expand modular business. So this was a summary of modules. Here you see also in the materials how their historical sales have been developing, and also the good EBITDA levels. Okay, now it's just time to wrap up the things. So still we see that the Ukrainian crisis, or the prolonged Ukrainian crisis and the spreading of it has impact in Russia, especially in Russia. Growth in the Eurozone is now, as I showed earlier, expected to strengthen in coming years. Difficult to say how much slower it will be as has been estimated. This we have to see very cautiously. On the other hand, growth has been slowed down by the strong euro. But now, during the third quarter, the euro's external value started to weaken. So this may have impact also in the coming quarters. In countries outside the Eurozone, for us important Sweden, the economy is expected to grow somewhat quicker than in other areas. And construction activity we expect to pick up in all of our operating countries in next few years. And as you have seen in the materials, that our guidance we repeat here. All right, thank you for your attention so far, and now it's time to answer your possible questions. Let's take first here, and if there is anything, then from the web.
Artem Beleski, SEB. You mentioned that your utilization rate started to improve year over year at the end of Q3 and also now apparently in Q4. Could you be more specific? Is it purely Sweden basically where you've seen this kind of development, or is it also some other countries?
Of course, Sweden is so important us, and we have been expecting the good development because of very strong construction outlook. And that has been delayed. So most strongly we saw this in Sweden. But there has been also in other markets like Poland, improvement. And Germany, after the summer period, we have now seen, I would say, even a clear improvement in utilization. But that does not mean that it is in Germany on good level yet. So the trend is clearly now improving, but not on a good level yet.
And in terms of German development, so do you expect it to stay in black what comes to earnings for Q4, or is it?
Unfortunately, I cannot give a guidance for the fourth quarter. What we have tried to explain here is that now we are living good months in all the countries. So we are expecting good and even some cases strong performance by a month.
And then maybe last one, more detailed questions relating to your earnings in Q3 by different segments. So there have been clearly smaller losses what comes to this group non-allocated costs, or basically assets line in Q3. Could you maybe explain what happened there?
Yeah, if I explain shortly, I mean there are cost savings, then there are also some IFRS related, you could say cost savings or a slower amount of costs which relate to our IFRS 2, our share-based payments and those programs. And also some release just because in provision levels. But cost savings is a very integral part of that.
Okay.
So yeah,
Thank you.
yeah, partly it's cost savings, but in fact that we have changed somewhat our sales level, so there is some impact of some provisions which we have to book differently.
Okay, very good. Thank you.
Okay, further. No more? Is there anything from the web? Let's take that and then come back if someone has more questions here.
The question from Ari Järvinen, Danske Markets. First one, you said fleet utilization rates in Sweden had even increased year to year during September. What is your view on pricing in Sweden? At Capital Markets Day, you were quite cautious about pricing even in Sweden.
Yes, we are still maybe cautious on that, but I mentioned here that at least we see that there is in certain segments, selected segments, we can start increasing prices. What we do anyway now all the time is that we increase somewhat our pricing through our new dynamic pricing system, which covers now roughly 1/3 of the clients already. But yes, we are looking for price increases, but we have to now see cautiously how well the market is accepting this. And this is for Sweden.
Okay. Another question from Ari Järvinen. Q3 EBITDA in Norway was much better compared to Q2. Still you say that the cost saving impacts is still to become visible in Q4 and 2015. Could Q4 EBITDA even improve compared to Q3 in Norway?
Again, we are now commenting quarterly or guiding quarters, so it's difficult to comment so exactly. But yes, that's how it is that the impact is coming with a delay, and then the full impact only for next year. Was there anything else?
Yeah, there's a question from Johannes Grasberger, Nordea Markets. First, can you say if the fleet mix sold out to customers in Finland has improved from last year, because rental demand is forecasted to be down, but you are actually showing growth for first 9 months?
For Finland, there is not really change in fleet mix. Where we have advanced quite okay is that in fact we are having more revenue coming from other industries than construction. And that has been for a long time our aim. So that is also now having some impact already. So this is a continuous effort to have more and more revenue in other industries. I think this is more essential than the sales mix as such. I cannot see really big change in our sales mix otherwise.
And in the performance management model, it's not only on looking at your cost containment, but very importantly also on sales performance management. So we have succeeding in finding those sectors also within construction, like renovation, which are actually growing.
From Johannes Grasberger, what do you think is reason for Central Europe's lower utilization rate for the old core fleet? Can you say what the mix of old and new fleet is right now and where you want to be? Also, can you say what the overall capacity utilization in Central Europe was for Q3 compared to Q2?
Okay, very, very detailed questions, but yeah, the essential thing is that it's not only us. We know that the competitors have had similar kind of trend during the summer months, so that the utilization for construction equipment sector has been too low. What are the reasons? One is that still in Germany, companies have even invested in their own fleet and utilized that fully. And the market has not in civil engineering sector been so great that then rental could have had good enough utilizations. I think this is one of the essential things. Then not giving exact, and actually I don't really now have the figure, the exact division how much we have construction equipment, but still it is our biggest, clearly the biggest product group in Germany. So of course that is continuously now important that we keep their good utilization levels. So it is not yet time that the new investments could replace that. That is much more further away. I would say it takes some years still before we are there.
Still from Johannes Grasberger. Fortran sales are down quite clearly, apparently due to FX reasons. Where are the cost adjustments coming from?
Now, of course, we are not operationally on top of the company, but I would say that it is the normal where our costs are. It is cost savings in the organization mostly, and then what comes to cash flow, it is that the investment levels have been taken very much down.
Number 4. Other EBIT line was at -1 million compared to typical around 2 to 3 million negative per quarter. Is there something unusual in this quarter, and should we expect a typical 9 to 10 million negative number for full year?
Where was that in?
Other EBITDA line.
In which line?
EBITDA line. It says here.
I don't think we got. Can you repeat the question once more?
Other EBIT line was at -1 million compared to typical around 2 to 3 million negative per quarter. Is there something unusual in this quarter, and should we expect a typical 9 to 10 million negative number for full year?
I'm not sure about the question. If it relates to this, that our non-allocated group activities were at a lower level than for instance last year, I think we already answered to the question posed by SEB.
Okay, has this raised further questions in the audience here? If not, we thank once more. Thank you and welcome after some months to follow next time Q4. Thank you very much.
Thank you.